Hi all. Now we are discussing a topic SVA, shareholder value added. Actually, when a firm make more profit means profit in excess of cost of capital, only it will result in the value addition to equity shareholders. That means if there is a profit after making payment of interest, shareholders capital cost, etc., there will be value addition. This addition is referred to as shareholder value added. Shareholder value added is the economic profit generated above and beyond the minimum return required by all providers of capital. It means that there are different providers of capital, just like equity shareholders, preference shareholders, debenture holders, etc. Shareholder value added is the profit generated in excess of these minimum return to be given to all the providers of capital. The shareholder value is the total value of equity. If a company makes profit in excess of these cost of capital, it creates value. That means a company creates value if the return of the shareholders exceeds the cost of equity. For example, shareholders has invested 10 lakh rupees and they need a return of 1 lakh rupees. There will be shareholder value addition only if the profit is in excess of that 1 lakh cost of equity capital. So, if the return is in excess of that 1 lakh, we can say there is value creation. And a company destroys value if the return of shareholders is less than cost of equity. കമ്പനിയുടെ ഷെയർഹോൾഡേഴ്സിൻ്റെ റിട്ടേൺ, ഇപ്പോൾ ഈ പറഞ്ഞ എക്സാമ്പിളിൽ ഇഫ് ഇറ്റ് ഈസ് ലെസ് ദാൻ 1 lakh rupees, if the profit is less than 1 lakh rupees, we can say there is value deterioration. So it destroys value if the return of shareholders is less than cost of equity. Then shareholder value is equal to the overall economic cash flows minus cost of all capital, both equity and debt. Specifically, shareholder value addition means overall economic cash flow, overall economic profit minus cost of all capital, cost of equity, cost of debt, etc. So when we deduct the cost of all capital from the overall profit, we can say there is shareholder value addition. Shareholder value is equal to the corporate value minus market value of debt. Corporate value is the total value of the firm. So when we deduct the market value of debt, because in the value of a firm there are two elements, value of debt, value of equity. The value of debt plus value of equity is equal to corporate value. So to find shareholder value, we deduct market value of debt from corporate value. Corporate value is equal to total economic value of the company. The total value of the company is called corporate value, or corporate value is equal to shareholder value plus value of debt. There are two elements of capital, shareholder and debt holder. So corporate value is equal to shareholder value plus value of debt. So corporate value includes a lot of elements. Corporate value includes present value of cash inflows. The total value of the firm includes the present value of cash inflows for each year. The residual value beyond the forecast period, that means the residual value, the scrap value we will receive after the life of the project, or at the at the end of the term of the project, and the current value of marketable securities. All these elements are covered under corporate value. So corporate value is the total economic value of the company. Shareholder value is derived by deducting the value of debt from total corporate value. Then a company creates value. We have already mentioned, and I am repeating, a company creates value if the return of shareholders exceeds cost of equity. A company destroys value if the return of shareholders is less than cost of equity. There are 5 different approaches for measuring shareholder value. These approaches are American approach. It is one approach, American approach. I will explain these approaches in detail. One of the approach is American approach. Second one is Alcar approach. It is the approach given by Alcar Associates, so it is called the Alcar approach. Then McKinsey approach. The third approach is McKinsey approach. It is the approach suggested by McKinsey. Then discounted cash flow approaches. Discounted cash flow approaches, in this case we will discount the cash inflows to find the value of the firm. Then EVA, another approach is EVA, economic value added, we will explain in detail. And MVA, market value added. These are the 5 approaches for measuring shareholder value. We will discuss these approaches here. So